back to the CNBC TV 18 special. My guest is Mr. Rajiv Lall, and now I'm going to address him as the Managing Director of the imminent IDFC Bank. Okay, Mr. Rajiv Lall, give us some idea of the blueprint you have in mind. On day 1, October 1st, 2015, if that is the date it is, how many branches will you have? Do you expect you will have?
So I'm still not in a position to tell you how many branches we'll have day 1. But I can give you some sense for our blueprint, if you like. We are going to be a universal bank, and what that means is that we will address 3 segments of the landscape. The wholesale bank, which will be a natural and logical extension of the business that we currently do. We will systematically build a consumer bank which will be focused primarily on tier 1, tier 2 India, and we will focus on let's call it mass banking, which will be focused on tier 5 and tier 6 India. So we are going to hit all 3 of these customer segments or different segments of the marketplace. So in many ways you can expect, and this is, remember, I keep saying this, building a bank is not a sprint, it's a marathon. So when we do launch in October of next year, this will only be the beginning of a journey. But at the beginning, what you will see is what I call a bimodal approach. So you will see us in the metros. You will see us in corporate banking at one end of the extreme, and at the other end of the extreme you will see us in a bunch of concentrated districts. We cannot be in 640 districts, but over time we expect to be in 40 odd districts where we will have a very, very significant presence in terms of rural banking.
Okay, so you are planning to have a large number of business correspondents. Have you signed up with a lot of, NDFCs can be business correspondents. Right. That would be one of the modes you'll use. Right.
So that's actually it's a wider question that you're raising, and I think it's worth spending just a minute on this. For a bank, a new bank in this day and age, right? There are 2 things that are going to be very different. One is technology. Clearly, technology has to become a defining feature of the new IDFC Bank, and that will translate into how we connect with customers, how we deliver services to customers, and at what cost we are able to deliver that service to the customer. That's one. And second is, again, running in this marathon, and given the very rapid changes that are taking place in the marketplace, partnerships of different kinds will be extremely important for us. It's not just business correspondence. We are looking to partner with other types of companies, other types of firms that will help extend our reach in ways that you haven't seen so far with banks.
Okay, that's whetting our appetite and our excitement. But your recent P&L gave us some indications of you preparing for the eventual bank. First, what will be under IDFC Bank, the demerged entity? All financing activities, what will not be over there? What will be with IDFC?
So IDFC will basically be a holding company that will have it'll have only our non-financial subsidiary, the only one that we have, and that's IDFC Foundation. The other,
the holding company?
The holding company, then there will be a non-operating finance holding company. Underneath that, you will have 5 financial subsidiaries: the bank, IDFC Alternatives, which is our private equity and infrastructure equity franchise, IDFC Mutual Fund, IDFC Securities, and IDF NBFC, which is going to be our infrastructure debt finance NBFC.
Okay. Well, we saw you actually increasing your provisions. How much do your provisions cover in terms of restructured and NPLs? The provision coverage ratio would be?
Today, it's very high. I mean, our loan loss coverage ratio, we are at close to 3% of our assets.
Yes, more than that, I think.
Yeah, and in terms of our restructured assets, I'd say our loan loss coverage is at least 60%.
So you would do more of that as you move towards...
Yeah, so we want to do more of that. See, we are in the fortuitously in the good position that we have sufficient amount of capital, so we can be, shall we say, much more transparent about the nature of our challenges, and our goal is to provide sufficiently.
Sufficient would be what, 80% you would want provided?
Let's say at least 70%, in the range of between 65 to 70%. I want to be able to provide against our stressed assets, that we can start the bank with a completely clean slate.
Okay. Now, one of the advantages should be that you will not have to keep SLR CRR for a substantial portion, because RBI's rules have now changed, especially if you're going to finance them with infrastructure bonds. Have you got any indication of how much you may get exemption from?
So
for what?
We know that at least a third of our existing balance sheet will be eligible for this treatment, and we know that with each passing year, an increasing share of our balance sheet will become eligible. Existing loan book will become eligible for these.
Do you have to? I mean, I assume you have to get specific permission from the Reserve Bank. Have they told you how much of your loan book will be eligible for this exemption?
So we don't have an exact number yet. That will be...
Somebody was guessing 60%, one of the research reports said. Is that a fair number to go with?
We won't know until the regulator actually, we sit down with the regulator.
When will this conversation happen?
So we have to first migrate our assets to the bank. So that will happen over the next few months. So I expect that these details will be sorted out, let's call it a quarter before our launch. So it won't be until, June-ish, I would say, of 2015.
Okay. And until then, we will also see you investing more in G6 and tapering your exposure to infrastructure.
Yeah, I mean, tapering our exposure to infrastructure, that depends on really what the situation or circumstances in the infrastructure space. If a lot of these risks that currently look high begin to get mitigated, we will return to growth in our infrastructure book. Right now, we are not looking to grow the book, at least through the transition over the next 12 to 18 months. But we are in no hurry either to run the book down.
Okay. Fair enough. But, I mean, other signs of moving towards the bank were that you made some principal gains as well. Your non-interest income was big. Will we see more of that?
Yes, you will see more of that.
Okay. And that will be used, spent on, booking space for bank branches, recruiting staff. Is that the reason why you are making these non-interest incomes? So
there are two reasons why. I mean, one is that as a bank, there are capital market exposure limitations, etc. We need to make ourselves compliant with all those restrictions. And second is that it actually allows us to underwrite some spending, spending for the transition. as we get ready for the bank.
But the problem also is that, you know, some licenses were given 10 years ago, and those two guys are still raising savings deposits at 6 and 7%. That will be a challenge you will have to encounter. You have to match that.
Yeah, no, you don't have to match that if we don't want to. I think that it will take a long time to build a depository franchise. It's not going to happen magically overnight. And I am not convinced. We will have to test all this, so we don't have a magic formula. But a priori, I'm not convinced that the sustainably effective way of building a depository franchise is just to offer a much higher rate than everybody else. I think that it's actually much more complex than that. And that's the challenge. And I think that's going to be our biggest challenge. I think the way of building a sustainable depository franchise is to deliver a quality of convenience and service and reliability that customers have not seen. That's easy to say, that's very, very difficult to deliver. And I think our goal is to actually deliver that. And our belief is that as we do that and people experience the IDFC bank service, over time we will build our depository franchise.
No, I agree with you, but even now, every other day, somebody is trying to buy ING Vaishya's bank simply because that's the fastest way to grow. Are you also throwing your hat in the ring?
No, we're not. Not at all.
Any acquisition, because simply because it's not easy to reach such a large country. Would acquisitions be something we will hear even before October 15th?
No, you will not. I can say that categorically, and I'll tell you why I can say that categorically. Our goal, as I said, is to deliver a differentiated value proposition to customers. I really want for IDFC Bank to be a distinctive bank, right? And our biggest advantage today is that we have no legacy. We have no technology framework or platform, nor do we have branches, nor do we have a large employee base. If we don't take advantage of this starting position to actually try to do something different that the customer will connect with differently, we will lose our one and only chance. If we just buy something else, then we just become another bank. So maybe we end up forced to do that. I certainly don't want to start with that mindset.
Okay. No, I take your point. That this could be turned into an advantage. Nevertheless, in a country like ours, where brick and mortar is needed for a bank, especially in unbanked areas. So, you know, branches, at some point in time, it may be attractive for you to buy an existing franchise. Not crossed your mind?
Well, I'm not thinking about it today.
Okay.
Because I really believe that so there are different parts of the marathon that can be run differently, but the first leg of the marathon will not be run on the back of an acquisition.
Okay. Well, finally, you know, as you become a bank in October 2015, what percentage will be exposed to infrastructure? Because we have seen that you're increasingly giving working capital loans. So you would have a reasonably diversified portfolio by October?
No, I mean our portfolio will be very concentrated in infrastructure to start with, because that's been our history and legacy. And I think even 5 years from now, our exposure to infrastructure will be proportionately much larger than almost any other bank. And I don't think that infrastructure will remain in the doldrums forever. Infrastructure looks like it's going to come out of it, and we will then take advantage of our experience and our pedigree to actually do a disproportionate amount of infrastructure business relative to our competition in a commercially profitable manner.
I can tell you the Prime Minister will be very happy to hear that from you. Rajiv Lall,
Thank you.
Pleasure speaking with you. Thank you very much, Mr. Latha.